Welcome to the Deep Dive. Today, we're plunging into a truly astonishing story. It's about how one man, Charles Koch, built this monumental $125 billion empire, Koch Industries. Get this, the second largest private company in the U.S., and built almost entirely, in silence.
Yeah, in silence is the key phrase there.
Exactly. This isn't just, another business success story. It feels different. It's about how he fundamentally rewrote the rules, embracing strategies most CEOs, frankly, probably only dream of, because they just defy conventional wisdom. So our mission today is really to uncover the how behind this silent colossus, pull out those surprising insights for you.
And that's really the untold narrative, isn't it? The one we're here to unravel. Just think about this for a second. When Charles Koch took over Koch Industries back in, 1967?
Yeah, 67.
It's pretty modest. Hundreds of millions in revenue, maybe. A blip compared to what it is now.
A totally different scale.
Totally. So to transform that into a $125 billion powerhouse by 2023, and to do it all while deliberately avoiding the public markets. That points to a completely different playbook. We're going to explore those radical decisions, the philosophy underneath it all, that allowed this incredible, almost invisible growth.
Okay, let's unpack this then. Maybe the most striking thing, the most contrarian choice Charles Koch made was just refusing point blank to do an IPO.
Right.
I mean, in an era where every startup dreams of ringing that bell on Wall Street, turning down that kind of capital. Public validation seems almost backward. Why would any company deliberately choose not to go that route?
Well, it wasn't backward thinking at all. It was profoundly strategic and deeply philosophical, actually. It came from this really clear-eyed understanding of the trade-offs involved.
Trade-offs like what?
Like Koch saw that, an IPO brings in cash, brings prestige, but it also comes with a heavy price, often a debilitating one. He wanted to avoid that relentless pressure quarter after quarter, the earnings reports.
The short-term market reactions to everything.
Exactly. That constant, exhausting need to beat the street. It's a treadmill, And it can force even really visionary public companies into making pretty short-sighted decisions. By staying private, Koch Industries just gained this profound freedom to focus entirely on a much, much longer horizon.
Decades, not quarters kind of thing.
We're talking decades, not just the next fiscal quarter.
That multi-decade view is, it's incredibly rare today, especially in the corporate world. Can you give us a solid example, like a major investment decision Koch Industries made that a public company just couldn't have, or maybe wouldn't have dared to try because of those short-term pressures?
Oh, absolutely. This freedom let them back investments that public companies often, shy away from because they need to show immediate profitability. Think about their commitment to R&D, pouring serious money into projects that might not show returns for 5, 10, maybe even 15 years.
Wow.
Or acquiring companies that weren't immediately profitable but offered huge long-term strategic value, even if they looked a bit tangential, to their traditional oil and gas roots.
Right, branching out.
And they could nurture internal ventures too, let them fail fast, iterate, learn, without that fear that early losses would trigger some kind of public scrutiny or investor panic. When you don't have a stock price dictating every move, you can genuinely play the long game on every single decision.
And we saw a huge, really bold example of this just recently, didn't we? With their acquisition of Infor back in 2020.
Yes. The software company.
A cloud-based software company. That was a $13 billion move for an industrial giant. That felt like a massive departure.
It absolutely was. And it perfectly illustrates the point. That audacious push into enterprise cloud software with, like you said, no immediate profitability expected. That's a move very few public companies, especially with a traditional investor base, would have dared to try without facing just immense pressure.
Shareholders would have been screaming, probably.
Yeah, you bet. They'd demand immediate returns or question how it fit the core business. Koch Industries, being private. They could make that bold, transformative bet. No hesitation, no external second-guessing needed. They prioritized building long-term digital infrastructure over, the immediate short-term optics.
It really throws into sharp relief how contrarian this whole approach is.
Yeah.
I mean, you look around, so many public corporations seem to be sacrificing long-term stability just for that short-term bump in share price. Koch's model is it's the fascinating counter-narrative. It's no wonder younger entrepreneurs are starting to study it.
Yeah, they're seeing the downsides of that public market hustle, looking for other ways to scale.
Okay, so that structural independence, the freedom from quarterly pressure, that must also give them incredible internal agility, right? How does not having external shareholders constantly looking over your shoulder actually impact their ability to make quick, decisive business moves?
Oh, it's huge. It gives them immense control over their own destiny and unparalleled speed in decision-making. They're just not encumbered by the usual bureaucracy.
Less red tape.
Way less. Charles Koch recognized really early on that agility, just the speed and quality of your decisions, that's often the key thing in seizing market opportunities, especially the fleeting ones. In a public company, every strategic move, especially if it's unconventional, it usually has to go through multiple layers: board approvals, shareholder communications.
Sometimes even public debate.
Right. And all of that just slows the whole process down. Often they miss their moment entirely because of it.
So, no need for those lengthy presentations to analysts trying to explain a really complex strategy in a simple quarterly report. Allows for much swifter execution.
Precisely. At Koch Industries, the decision rights are often distributed based on expertise, not just rigid hierarchy. That's a core part of their market-based management philosophy, which we should definitely talk more about.
Yeah.
The idea is the person closest to the problem, the one with the best knowledge, the comparative advantage, they have the authority to act quickly, decisively. So this could mean like a mid-level engineer greenlighting a multi-million-dollar plant upgrade.
Really? Yeah. Without going way up the chain.
If they have the demonstrated expertise and it aligns with the principles, yes. Or a business unit head executing a major acquisition without months of bureaucratic delays or needing to convince outsiders. It's a kind of radical trust in talent and knowledge within the system.
That sounds profoundly different, like fundamentally different from most corporate structures. Can you maybe sketch out a scenario where this distributed decision rights thing let Koch pivot or grab an opportunity that a more, hierarchical public company might have totally missed?
Okay, sure. Think about the pace of change in technology today. Lots of big industrial companies are kind of slow to adopt new systems, right?
Definitely.
But Koch's approach, it lets them move faster. So maybe a business unit lead, say in one of their manufacturing sectors, identifies some cutting-edge AI solution for supply chain optimization, maybe? Because decision rights are distributed and they're empowered to act like owners. They wouldn't necessarily have to wait for some centralized IT committee or board approval that could take months.
Right.
They could potentially prototype it, evaluate it, integrate it much more rapidly. Meanwhile, a public company with all its layers of approval worrying about the immediate ROI on that new tech investment, they might still be debating it while Koch is already implementing it and seeing the benefits. That kind of swiftness, it's a fundamental part of their competitive edge. And what's truly fascinating here is how this internal agility actually strengthens the company culture. Employees at every level, they understand that authority comes with real accountability, serious accountability. There's no hiding behind, orders from above or board mandates.
That makes sense.
The expectation is that each leader, doesn't matter the rank, thinks and acts like an owner, constantly looking for ways to create value. And that fosters incredible innovation, I think, deep loyalty too, and just a powerful sense of personal responsibility for results. For a company of Koch's size, 120,000 employees globally?
Huge scale.
Immense. This structure isn't just a competitive advantage, it's probably a fundamental survival mechanism. It prevents that kind of corporate paralysis you see in other giants.
Okay, so moving from that internal agility, let's talk about how they spread their bets. Wow. Historically, Koch Industries was really rooted in oil and gas, a notoriously volatile industry. How did they manage to avoid that trap? Over-reliance on one unpredictable market, especially given the scale they were aiming for.
Well, it is a very aggressive, very methodical, and I'd say incredibly insightful strategy of diversification. Charles Koch understood that even if they completely dominated their core oil and gas market, that over-reliance could eventually be their biggest vulnerability, their Achilles heel.
Right.
So they diversified not just to spread risk, although that was part of it, but also to position the company for growth in markets far, far beyond their original domain. They essentially created this robust multi-industry ecosystem.
And they went into a surprisingly wide range of areas, didn't they? Things most people probably don't even associate with the Koch name.
Oh, absolutely. Over the decades, they just aggressively expanded. Manufacturing, agriculture, consumer goods, chemicals, energy trading, logistics, you name it. A really monumental move was that $21 billion acquisition of Georgia Pacific. That was back in 2005.
Georgia Pacific, yeah. Paper products, building materials.
Exactly. It instantly made them a major player in paper, building materials, consumer tissue, a world away from oil refining. They also acquired Invista, the maker of Lycra, and other synthetic fibers.
Lycra, wow.
Yeah, and these weren't just about adding separate revenue streams. They were about creating these interlinked business ecosystems where different divisions could actually supply and strengthen each other, building what I sometimes call a web of resilience.
Okay, a web of resilience. I like that. But lots of companies diversify, right? The real test is how that portfolio performs when things get rough. How did Kent's broad portfolio actually hold up when the economy hit turbulence, like those big oil price collapses or the 2008 financial crisis? Did it truly give them the insulation they were hoping for?
It absolutely did. And it's really one of their defining strengths, I think. When oil prices collapsed, which they did dramatically, mid-'80s, mid-2000s, again, in 2020, the consistent revenues, often counter-cyclical revenues, from their other sectors really cushioned the blow.
Counter-cyclical, meaning they do well when oil does badly.
Sometimes, yeah. Or they're just less affected. Think consumer products, agricultural inputs, certain chemicals. People still need those things. During the 2008 crisis, while so many companies were just reeling, drowning in debt, demand for Koch's essential consumer goods, energy services, it allowed them to avoid catastrophic losses. And it even positioned them to make opportunistic acquisitions when assets were cheap.
Ah, interesting.
The sheer scale and the interconnectedness of their portfolio, it means if one division faces a downturn, others can often carry the weight. It makes the whole enterprise remarkably durable, for generations potentially. It's a very deliberate strategy to build that robustness right into the structure of the company itself.
We've talked about the structural choices staying private. We've talked about the vast diversification. But what's the ultimate secret sauce here? What's the internal philosophy that guides all this, that holds it all together across so many different businesses?
Right. That would have to be market-based management. MBM. It's not just like a set of principles you hang on the wall. It's a comprehensive operating system. Charles Koch developed it over decades. It's deeply rooted in free market economics, and it governs pretty much everything. How people are hired, how capital gets allocated, how success is even measured. It's arguably the most critical piece that distinguishes Koch Industries.
So much more than just a mission statement, then. It's really an operational blueprint that kind of permeates the whole organization. And I understand it pushes for a real entrepreneurial mindset, right? Even way down the ladder.
Precisely. MBM is built around these 5 core dimensions. There's vision defining that ultimate purpose, long-term value creation. Then virtue and talents, making sure you have the right people. Integrity, humility, the right capabilities. Knowledge processes, relentlessly seeking out, synthesizing, applying the best information available. Decision rights, which we touched on. Empowering those with the best knowledge wherever they are. And finally, incentives aligning rewards for individuals and teams with the genuine long-term value they create. It's truly a holistic system. Designed specifically to scale that entrepreneurial thinking, it literally encourages every single employee to think like an owner.
That sounds incredibly powerful. But, how does it work day to day?
Yeah.
Practically. You mentioned an internal competition of ideas earlier. How does that actually play out in a tangible way inside such a huge company?
Well, it's almost like an internal market. For capital, for talent, for resources. Business units don't just, submit a budget request. They essentially pitch for resources. They have to demonstrate how their project, whether it's a new refinery tech or a software innovation, whatever, how it will generate the highest value. And specifically, good profit for the whole enterprise.
Good profit.
Yeah, that's a key distinction within MBM. Yeah. Good profit versus bad profit. Charles Koch explicitly discourages what he calls bad profit. That's gains earned through things like regulatory favors, government subsidies, maybe exploiting customers because they lack choice.
Okay, not sustainable value.
Exactly. MBM directs the company toward good profit earnings generated by creating genuine, mutually beneficial value for customers, for society. And this ethical emphasis over time has helped Koch build these incredibly enduring relationships with customers, with suppliers. It fosters long-term trust and loyalty.
So the internal market forces constant reevaluation. Keeps capital flowing to the best ideas.
Right. It ensures capital flows to its highest and best use, ideally. Not just to the loudest voice in the room or the division that's been around the longest. It's about creating that mutually beneficial value. And if we connect this back to the bigger picture, MBM really functions as the primary cultural glue. You've got 120,000 employees, 70-plus countries. MBM ensures the same core decision-making principles apply everywhere, whether you're in a refinery in Texas, a paper mill in Georgia, or a software office in, say, New York. While other corporations might rely on rigid policies or heavy central control, MBM creates this shared mindset that allows them to scale without stifling local initiative. Charles Koch has even written extensively about it in books like The Science of Success and Good Profit, laying it all out.
Okay, let's shift focus slightly. From the philosophy to the people themselves. Charles Koch famously said something like, the greatest determinant of a company's future is the quality and values of the people. So how does Koch Industries approach talent? Not just hiring, but, strategic succession planning across such a vast, complex organization.
Yeah, their approach, it goes way beyond just looking at technical skills on a resume. They focus really intensely on hiring for what they call virtue and talent. They're looking for individuals whose personal virtues, things like integrity, humility, curiosity, that relentless pursuit of knowledge, align with their long-term thinking, their principled entrepreneurship.
So cultural fit is paramount.
Hugely important. And once someone is hired, they're given immense autonomy, real responsibility. The expectation is clear. Act like an owner, not just an employee punching a clock. And this naturally fosters leadership grown organically from within, which ensures that cultural and strategic continuity over time. It's really about empowering people to be entrepreneurs, but within the framework of the larger enterprise.
So it's much more about deep integration, long-term development, less of that common corporate cycle of bringing in star leaders from outside every few years. That must be a huge factor in their stability.
Exactly right. Succession planning at Koch isn't an afterthought. It's a deliberate, ongoing process, often spanning decades. Unlike many family-owned companies that really struggle with generational transitions, Charles Koch seems to have made it a strength. He strategically transferred, I think it was over $5.3 billion in non-voting equity to charitable foundations and the next generation of the family.
Non-voting equity, so influence without direct control issues.
Right. It preserves the family influence and values without creating those huge liquidity challenges that can force sales or breakups when an owner passes away. And operational leadership has also gradually shifted over time to internal executives who are just deeply steeped in market-based management, ensuring that unwavering alignment with the long-term vision continues.
That kind of stability, it must be a monumental advantage. It completely sidesteps those pitfalls public companies face, like, rapid CEO turnover driven by impatient shareholders or activist investors shouting for change. How does that stability translate into their ability to make those really bold, transformative investments without worrying about leadership upheaval?
It's transformative for decision-making. Leaders at Koch, they're selected, they're groomed with the understanding that their decisions have to serve the company's health decades from now, not just the next quarter's results. This deep-seated stability allows for those bold moves we talked about, Georgia Pacific, Infor, without the kind of leadership churn or sudden strategic shifts that might derail such ambitious plans elsewhere. It really comes down to investing early, nurturing patiently, and aligning incentives for the very long haul, knowing that the leadership structure itself is built to endure those long cycles.
Okay, thinking about long cycles. Charles Koch's career spanned decades of incredible turbulence. We're talking oil embargoes in the 70s, the 2008 financial meltdown, the 2020 pandemic. How did this company not just survive all that, but actually seem to thrive through it, coming out stronger each time, it seems?
Well, again, that absence of public market demands was just critical, a key differentiator. Koch Industries wasn't operating under that constant shadow of quarterly earnings disappointment or panicked investor calls demanding immediate action. This freedom let them act on a multi-year, sometimes even multi-decade timeframe during downturns. For instance, back in the 2008 financial crisis, while so many firms were slashing budgets, retrenching, laying people off, Koch actually deployed significant capital into strategic acquisitions, into expansions, knowing that asset prices were depressed.
That is completely counterintuitive, isn't it, for how most companies react in a crisis? Instead of hunkering down, they actually doubled down.
It is counterintuitive if you're only focused on the next quarter, but not if you're focused on the next decade. Their diversified portfolio also played that huge role, cushioning the blows. Like the 2014-2015 oil price collapse, other divisions helped absorb the impact. And their MBM philosophy, it guides their whole crisis response. The steps are clear. Rapidly gather the best knowledge, assign decision rights to those with the relevant expertise, and then act decisively with courage.
Got it.
During the 2020 pandemic, for example, their vertically integrated operations let them quickly reallocate resources internally. Their paper and packaging divisions, they ramped up production like crazy to meet that surging demand for e-commerce shipping materials, hygiene products, and that directly offset losses in other sectors hit harder like fuels or certain chemicals.
So they don't just ride out the storm, they actively use the disruption as an opportunity for strategic advantage.
Exactly. Their crisis playbook absolutely includes actively looking for undervalued assets, market dislocations during contractions. That Georgia-Pacific acquisition in 2005, while not technically during a recession, it reflected that same opportunistic mindset. They saw a chance to acquire a market leader when public competitors were maybe more constrained financially. And the same thinking, I'd argue, underpinned their aggressive push into technology in the late 2010s, leading up to that Infor acquisition. At a time when many traditional industrial firms were still pretty hesitant to commit heavily to digital transformation. Which really raises an important point about how Charles Koch viewed crises. For him, they apparently weren't interruptions to the plan. They were kind of part of the plan, expected turbulence. He saw them as catalysts for rebalancing the portfolio, for investing wisely, and for reinforcing the core values that keep decision-making aligned with those long-term goals. By just refusing to panic in the face of short-term volatility, Koch Industries has repeatedly positioned itself to capture market share, to gain influence when conditions eventually stabilize. They are really masters of the long game.
So as we kind of wrap up this deep dive, the core lessons here from Charles Koch and Koch Industries, they really seem to be about the compounding power of what? Disciplined philosophy, radical structural independence, strategic patience.
All of the above.
Privacy wasn't just like a preference for them. It was a profound strategic enabler. It enabled that patience, that massive diversification, the proactive crisis management, and that unique ability to cultivate talent from within for the long haul.
Indeed. It's such a powerful reminder, I think, especially today. That enduring advantage, in an era that's just obsessed with speed, visibility, short-term gains, it often comes from the exact opposite, from patience, discretion, principled, long-term execution. Koch Industries proves that a business can scale to $125 billion in revenue, operate across dozens of sectors globally, influence markets, and do it all without ever needing a public stock exchange listing. Success isn't always about being in the spotlight or chasing the stock price. It's about building lasting value, generation after generation, without compromising the core principles that made it all possible in the first place.
Which brings us nicely to our final provocative thought for you, the listener. If you had the freedom to build something, without answering to quarterly targets, without the constant scrutiny of external shareholders, what kind of enduring empire, big or small, would you create? Think about how those constraints, or maybe the absence of them, would shape your own vision, something to chew on. We'll catch you next time on The Deep Dive.